the Wild West of finance. It's taken the world by storm, turning teenagers into millionaires and also draining the bank accounts of plenty of grannies out there. You hear people preaching to stay far, far away from crypto because it's impossible to profit in the long run, it's full of scams, and you'll eventually lose everything you invested.
Commodity trading has a long and storied history, marked by incredible successes that have yielded vast fortunes and shaped economic policies and trading practices worldwide. These successes often stem from acute market insight, strategic innovation, and, sometimes, just being in the right place at the right time. Exploring these historical victories provides fascinating tales and invaluable lessons for modern traders. Section 1. Notable success stories in commodity trading. One of the most notable success stories in commodity trading involves the legendary figure of Jesse Livermore, commonly known as Wall Street's Great Bear. Livermore's trading career was highlighted by his spectacular gains in the early 20th century, particularly during the 1907 and 1929 market crashes. He made a fortune by short selling, predicting market falls with uncanny accuracy. His success was based on the principles of price action and market psychology, which many modern traders still rely on. Another historic triumph in the world of commodities occurred in the silver market in the late 1970s. The Hunt brothers, Nelson Bunker Hunt and William Herbert Hunt, attempted to corner the global silver market. At one point, they were estimated to hold 1/3 of the world's silver supply outside government reserves. Although their plan eventually led to a spectacular collapse, at its peak, it drove silver prices to an all-time high of $49.45 per ounce in 1980. Moving from precious metals to energy, the oil market has seen its fair share of legendary trading successes. Mark Rich, who founded the commodities trading giant Glencore, was instrumental in developing the spot oil market during the 1970s oil crisis. His innovative approach to trading and circumventing politically driven oil supply restrictions redefined energy trading and made him one of the most famous figures in the commodity world. In more recent history, the natural gas market witnessed one of its most successful trades by John Arnold of Centaurus Advisors. A former Enron trader, Arnold capitalized on the volatile energy market of the early 2000s. His most famous trade came in 2006 when he earned nearly $1 billion in profit from natural gas futures. Section 2. Lessons from success in commodity trading. These stories highlight individual success and underscore several vital elements essential to success in commodity trading. First, an in-depth understanding of market fundamentals and dynamics is crucial. Whether Jesse Livermore studies price patterns or Mark Rich understands geopolitical influences on oil, having a deep understanding of what drives market movements is paramount. Second, adaptability to market changes plays a significant role. The commodity markets are known for their volatility and unpredictability. Successful traders adapt their tactics in light of fresh data and changing market conditions, often leveraging advanced technology and data analysis to stay ahead. Finally, risk management is a common thread among all successful commodity traders. Effective risk management strategies, including diversification, hedging, and setting appropriate stop-loss orders, are vital to protecting gains and limiting losses. Section 3. Notable failures and the lessons they offer. In business and finance, failures can sometimes be as instructive as successes, offering profound lessons that shape future decisions and strategies. Reflecting on notable shortcomings, particularly in the volatile realms of trading and investments, reveals common pitfalls and critical insights into risk management, strategic planning, and the psychology of decision-making. One of the most infamous failures is the collapse of Barings Bank in 1995, where unchecked risk and poor oversight led to disaster. Nick Leeson, a trader, took unauthorized speculative positions in Japanese stock index futures, leading to losses exceeding $1.3 billion. The collapse underscores the necessity of rigorous risk management systems and continuous oversight of trading activities. Another significant failure occurred during the 2008 financial crisis with the collapse of Lehman Brothers. The firm's high exposure to subprime mortgages, without adequate risk assessment or mitigation strategies, led to its rapid downfall. This event emphasized the importance of Maintaining a balanced portfolio and understanding the underlying risks of investment products. Section 4. Analysis of recent commodity booms and busts. Commodity markets are known for their cycles of booms and busts. In recent years, the oil market underwent dramatic fluctuations. From mid-2014 to early 2016, oil prices plummeted from over $100 per barrel to below $30, driven by oversupply and slowing global demand. The COVID-19 pandemic in 2020 caused prices to plunge once again due to reduced demand, highlighting the vulnerability of commodity markets to global events. In contrast, gold saw a significant boom in 2020, with prices reaching record highs due to economic uncertainty and concerns over financial stability. Agricultural commodities, such as coffee, also experienced price volatility due to supply chain disruptions and adverse weather conditions. These fluctuations underscore the growing impact of environmental factors and climate change on commodity markets, making sustainability and environmental risk management critical components of strategic planning. Section 5. Role of major players in shaping commodity markets. Major players, including multinational corporations, governments, and large trading houses, profoundly influence global commodity markets. Companies like ExxonMobil, Chevron, and Cargill significantly affect global pricing structures through their production levels and strategic reserves. Governments also play crucial roles, especially in resource-rich countries. OPEC, led by Saudi Arabia, controls oil prices through coordinated production quotas among member countries, impacting global economic conditions. Financial players such as hedge funds and investment banks shape commodity markets through speculative and investment activities. Their actions provide market liquidity, but their strategies can also lead to rapid price swings. Section 6. Strategies that led to significant profits. Diversification is one of the foundational strategies that has proven its worth over time. Savvy investors minimize risk by spreading investments across various asset classes, industries, and geographies. Market timing, though riskier, has led to significant profits for those able to predict market movements accurately. Value investing, popularized by Warren Buffett, focuses on identifying undervalued stocks with solid fundamentals and holding them until their price reflects their true worth. Arbitrage, leveraging, and hedging are also powerful strategies that have resulted in significant profits when executed with careful risk management. Section 7. Risk management practices from real-world examples. Risk management is an essential component of business strategy. NASA's rigorous testing protocols, for instance, ensure that spacecraft are robust enough to handle the unexpected, while Toyota's response to the 2011 tsunami demonstrated effective risk management by diversifying its supplier base. In contrast, the collapse of long-term capital management in 1998 highlights the consequences of failing to prepare for highly improbable events. BP's 2010 Deepwater Horizon oil disaster reinforced the importance of environmental risk management and regulatory compliance in high-risk industries. These examples emphasize the need for contingency planning, diversification, and continuous improvement in risk management strategies. Lessons from commodity markets. The history of commodity trading offers a rich tapestry of success stories, failures, and lessons that continue to shape the landscape today. From the legendary figures like Jesse Livermore to modern traders like John Arnold, the common thread among successful traders is their deep understanding of market fundamentals, adaptability, and effective risk management strategies. Equally, the notable failures, such as Barings Bank and Lehman Brothers, serve as reminders of the importance of oversight, diversification, and prudent risk assessment.